Welcome to our lecture series in financial management. Today, we will talk about inflation. Inflation is a key concept in financial management, impacting purchasing power, interest rates, and investment returns. It's a sustained rise in general price levels of goods and services, reducing money's purchasing power. Inflation means average price increases across the economy over time, not just individual changes. For example, coffee rising from $2 to $2.20, a 10% increase, reflecting broad patterns, indicates inflation. However, an oil spike raising gasoline costs while others stay stable is a relative change, not inflation. Inflation is measured by indexes like CPI, tracking consumer prices for a fixed basket of goods and services. PPI measures prices producers receive, often signaling future consumer inflation. GDP deflator broadly measures prices of all domestically produced goods and services. Inflation arises from demand pull, cost push, and built-in sources. Demand pull inflation occurs when demand exceeds supply during strong growth. Cost push inflation stems from rising production costs like wages or energy prices. Built-in inflation comes from wage price spirals driven by future inflation expectations. Inflation expectations critically influence workers, firms, and investors in financial markets. If lenders expect 4% inflation, they demand higher interest rates despite low current inflation. Financial management must distinguish nominal values in current dollars from inflation-adjusted real values. Ignoring this leads to overestimating profitability and purchasing power. The Fisher effect states nominal interest rate equals real rate plus expected inflation. Higher expected inflation raises nominal rates. For example, 2% real plus 3% expected yields 5% nominal. Inflation erodes real value of fixed coupon bonds, especially long-term ones. Stocks offer partial protection, particularly firms with strong pricing power. Real assets like real estate and commodities effectively hedge inflation. In corporate finance, inflation affects capital budgeting, cost of capital, and pricing strategies. Firms must consistently adjust revenues and costs for inflation to avoid projection errors. Inflation redistributes wealth, creating winners and losers. Borrowers with fixed debt, like homeowners on fixed mortgages, benefit as real debt burden decreases. Lenders and fixed income recipients lose as real value of returns erodes. Hyperinflation and deflation pose severe economic risks. Hyperinflation is accelerating high inflation, destroying money's value. Deflation is sustained price decline. Deflation discourages spending and investment as prices are expected to fall further. Understanding inflation is essential for informed decisions, protecting purchasing power and securing returns. Thank you for watching our lecture on financial management focusing on inflation. See you at the next lecture.